Awesome, awesome. Well, I'm going to talk a little bit about defined risk trading. This is going to be a pretty high-level overview. I know everybody's been on here for a while, and it is, well, at least where I'm at, it's a beautiful Saturday. So what I want to do is give a pretty high-level overview to a concept of spreads and a way to trade with defined risk. And I'm going to spend a lot of time talking about risk because I think it's a very real market concern. It's what leads to, when we hear everything about trading, a lot of times we're looking at strategies, we're looking at things, but obviously the psychology of trading, and probably a lot of you have heard that, is one of the most important things. And what happens oftentimes when people take too much risk is really where the psychological stress comes in. So let's see here. I'm going to go ahead and get started. And Morgan, I'll probably try to run this in about a half an hour. I do want to make sure I get everybody's questions answered. So what we're going to do today, I'm just going to give you a brief introduction. If you haven't heard of Nadex, I'm just going to give you a quick overview on who we are, because it kind of lends itself actually to the contracts we offer. We're going to take a look at the actual contracts, the spreads contracts, a quick strategy that can be used. Again, this is going to be pretty high level. This will not make anybody an expert. If I told you I could make you an expert in 30 minutes, I would just be lying. And so then we're also going to talk about how to get a demo account so you can take a look at it, and it's something I definitely encourage everybody to do before trading live. So with that, let's get in. Quick disclosure, you've probably seen a million of these so far today. Future swaps, options, stocks, anything you trade involves risk. Whenever you put real money in a market, you can lose all of that money. If it's a leveraged market, you can lose more than that, more than even what you put in. So you really want to definitely be comfortable with any market. Any trading decisions that you make should be solely your responsibility. We all have to take responsibility for our trades. This is going to be educational. We're going to be looking at a few charts. Please don't think anything that I say says, hey, you should go out and buy oil today. This is going to be hypothetical, and we're going to be taking a look at them. So let's get into that. With Nadex, very high-level overview. Nadex is the North American Derivatives Exchange. We are an actual exchange. We are based in Chicago. It's regulated by the CFTC, Commodity Futures Trading Commission, and so we are regulated as an electronic exchange. DCM, DCO, if you care about those, basically that's just what our designation is. DCM is the same designation as like the Chicago Mercantile Exchange or ICE. That just means we're a contract market or exchange. We're also a self-clearing organization. What I thought, and obviously I'm biased now, is that obviously I work for Nadex, so I expect everything you hear from me today you'll take with a grain of salt or some skepticism, because I would actually. But what I thought was cool even before I became to Nadex was when I looked at these contracts and how they were designed. One of the big things that we've seen in a lot of markets, if people are trading equities and they're active traders, there's this day trading rule. You've got to have, 25 grand put up to be active in stocks. On the futures side, there is quite a bit of capital needed to cover margin or just the risk per point. And the reason being is a lot of these exchanges and contracts have always been designed for the large institution to trade, not the active individual trader. And that's where really this unfilled niche. And that's what Nadex is really based on. We really believe that everybody should have access to the markets, not just large Wall Street institutions, but everybody. Now with that, obviously markets can be a very tough environment. They're not exactly kind to everyone. With the design of Nadex, all of the contracts are designed for that individual trader rather than the institution. So everything we're going to be talking about today, low cost of entry, all limited risk and fully collateralized, so you can't lose more money than you have in your account. Right now, all the contracts we do in the way that we do, that is open to direct individuals to come in as members. And I saw a question here as far as international or outside of the U.S. That's something that's going to be coming down the pipe pretty soon. We are working with some brokerage firms that have shown interest in basically listing these contracts so that their clients can trade. So let's get into the actual contract though, because I think that's what everybody's here. And if you've seen this before or familiar with Nadex from a while back, what is a bull spread? actually go ahead and forget the term bull at all. I hated that we ever called these things bull spreads. Be completely honest with that, because I thought it was very misleading. So what we're going to refer to them from here on out, and also to when I mentioned that to Morgan, he came up with a good catch line that I'm going to start using all the time. You know, the reason we're going to take away the bull is because there's no bull at Nadex. So from here on out, and you're going to see the website change pretty soon. We're working on that right now. These are just going to be referred to as Nadex spreads. The reason I never liked bull was that because with this contract, you can go long or short, depending on what your bias is. If you've traded options, it's basically a vertical spread. Whether you're buying or selling long or short, it's always limited risk. These are pretty simple contracts, particularly if you've traded Forex before or futures or really any market. They're simple, they're short term, all limited risk, fully collateralized. So whatever your risk is, and we'll take a look at that, whatever your risk is, that's what you put up. It's not really so much margin because it's not leveraged, but you're putting up your full risk like you would when you're buying a call or buying a put in options. And I have vertical call option spread. It could be a vertical put option spread. Floor and ceiling. And we're going to take a look at the charts with this because I think it'll really help explain the contract and how it trades. They're all priced for the retail trader. So $1 per tick on all of the contracts. And you always know your risk up front. And again, if at the end of this presentation you're still feeling a little bit confused, I would expect that. If this is the first time you've seen it, it's not something that you just necessarily grasp in 15 or 20 minutes. It relates very well if you've been trading the other markets, but I definitely encourage you, and I'll tell you how to get a demo at the end of this presentation. So let's just take a look at a chart. And this example is just oil, but really a chart is a chart. Markets move in really the same respect. Each one has its own, different nuances, but basically a chart is a chart. And so this concept, if you're trading the E-mini S&P or oil or currencies or gold, think about this more as an overall overview on just kind of how a trade typically sets up. So for example, we've got the oil chart here. Let's say we're buying oil at 75 now. Well, I wish I could go back a while and do that. Obviously, it's moved quite a bit since I constructed that chart. Say that we're buying oil at 75, and this is the underlying market. So what we're looking at are the charts of the underlying market. So this is the crude oil contract. So a typical trade might set up. We buy at 75. We put a stop in at 74. Now, not including any type of intraday margin, but if I was looking to hold this, I'd have to put up roughly, what, $6,800 in margin, actually more now with where it's at, but when I did this, about $6,800, maybe $7 grand in margin if we want to hold it. And if we were trading one contract, we've got $1,000 risk. So if I'm somebody with a $5,000 contract, it's going to be really difficult to place this trade because I don't want to risk 20% of my account on one trade. So let's just see. I don't know if this has ever happened to anybody. You put in a trade, the market goes against you, and you're stopped out. Now, I know this one happened to me quite often. All of a sudden, it bounces back up, goes in your favor, but it doesn't matter. Your trade's over. With this, and yeah, BH, I'm actually just talking about trading the underlying, not the options. And we're going to talk about options in just a minute. One of the difficulties, particularly for newer people on the just trading in general, we hear manage your risk, manage your risk, manage your risk, manage your risk over and over and over again. And it's extremely important. Amos Hofstadter said it, take care of the losses and the profits take care of themselves. One of my mentors early on said that the only difference between him, who had been trading 30 plus years, and somebody just starting trading was that he got out of his losing trades faster. The problem when a lot of people, particularly newer to the market, start hearing manage your risk, how do you do that? You do it through a stop loss, right? If you're trading oil or currencies, you've got to put a stop loss in. Unfortunately, a lot of people smother the market, and I've seen this happen a lot of times. I was a trading coach for a couple of years. They smother the market with a stop. Market just ticks a little bit against them, and bam, they're out. So all of a sudden, that stop starts moving farther and farther away, or the market starts moving, and all of a sudden, they start moving that stop, and they're just taking more and more losses. It's a tough thing psychologically, and any trader will tell you it's not an easy thing to do. It is manage your risk, figure out where to enter, where to place your stop. So we're going to do a very similar setup here, and there's a lot of, I see questions coming across. I'll try to get quite a few, and I think Chip is on here as well, so he'll be helping me out with questions, typing those out. So we've got the same setup, right? We've got oil trading at 75. With this spread, whoops, I think I clicked the wrong one here. We've got oil trading at 75. This is also the floor of the contract. There's a floor and a ceiling. So we've got 75, and I see a couple people saying they can't see the chart. I'm not sure. Hopefully it's coming through for most people. I don't know if Morgan has something, some way to refresh that, or if you need to go out and come back in. So we've got a floor of 75. Basically, that's the lowest that contract can price. We've got a ceiling of 80. So what we're looking at is trading in a range. So we're looking for, in this case, if we're trading near the floor of the market, our same bias as before, we're looking for the market to go up. This is an options type product. This is an options product. We've basically taken a very simple strategy, which is a vertical spread. Maybe I'm buying a call low and selling a put low. It's a range bound. So it is time bound as well. So in this case, we have an expiration. Let's say we're getting in early in the morning. We've got the market trading right around 75. I can buy this spread just like buying the underlying market. There's going to be a few factors though. The first thing, remember we mentioned the market was trading around 75, maybe 75.05. In this case, I'm going to pay a little bit of premium, and I'll explain why you do that. So in this case, I'm not going to be buying it right at the market because I'm close to the floor. So I might have in 25 ticks. Now this can be impacted by volatility and time as far as how much premium you may pay. For this example, we're going to say 25 ticks. It's 1 cent per tick. So we're buying at 75.25. Our risk on this trade now, because these are priced in $1 increments, is $25. If we wanted to do the equivalent of a per point equivalent of crude, we'd do 10 contracts. So basically, if it moved $1, it'd be a $1,000 gain or loss. So in this one, if we did 10 contracts, we put up $25 per contract, or $250. So substantially less than putting up the $6,800, $7,000 for trading the oil outright. Now for this, we're paying a bit of option premium, the 25 ticks that were off the market. But what happens is, this is not a stop. We've got the full range. Our risk is limited by the floor. If we were selling, it'd be limited by the ceiling. And we have a total potential upside of up to 80. That's our ceiling. So let's run through the scenario. Same thing happens as before. If the market just stays like this, now we've lost our 25. If it goes to expiration, it's down below the floor. The contract basically settles at the floor. That's as low as it can settle. We've lost $250. Versus if we'd traded the oil outright and got stopped out at 74, we'd have lost $1,000. So we've already capped our losses. Also, because this is an option, there's no stop. So if the market does rebound, we're basically buying time to be right. And that's why we'd be willing to pay that option premium up front. We're giving the market a little bit of edge, but we're getting the benefit of potentially much lower collateral to get into the trade, as well as not being stopped out. If you think about this, this is oil. If you think about trading around the Wednesday oil report, or if you think about trading around a non-farm or a Fed announcement, it can be very, very dangerous when you're using stops, because just whipsaws might take you right out of the trade. Or if it's a really big announcement, it can be gapped over. When I trade this at 75.25 and I've got a floor at 75, that's my worst case scenario. It doesn't matter if World War III breaks out. And it doesn't matter if I'm trading currencies, or if I'm trading commodities, or if I'm trading futures in equity indexes. Few other outcomes, because these things can happen, and you can tell, obviously I've doctored these charts because I've never seen a market that drops first and then goes back in time and then climbs. I wish I could actually create that though. That'd be fun. Let's say we buy it at that 75.25. If the market makes a move like this, and I'm going to bring up the spotlight here real quick, if the market makes a move like this and really runs, well, these are limited risk as well as limited reward. So the most I can make is up to 80. So if the market continues up, and let's say the market moves to 85, it had a huge move. It expires there, the most I can make is up to 80. So in this scenario, I've got a total of $5 or 500 ticks at $1 a tick per contract. So I could make potentially 475, putting up 25 per contract. Let's take another look at another scenario, because you don't have to hold these till expiration, and that's an important factor, particularly if you're trading around fundamental news shocks that just hit the market. You know, the Bernanke doesn't always call me up individually, or any of us individually, and say when he's going to come out and make a comment. So sometimes we might want to get out beforehand. Sometimes we want to do a sometimes we want to you know, basically put a limit order out there. And BH, put a trailing stop to the upside. No, and actually I'll explain why. One of the key benefits of this is not using a stop. But what I'm going to talk about in a little bit, which I think you'll find interesting, is actually using these in conjunction with an underlying market trade, basically to buy insurance. So I think I'll answer your question in just a minute. But that's a great question, and one that comes up quite often. One of the benefits here is not using the stop on the initiation of your trade. So if it does go against you and then bounces back up, but I definitely understand the question that BH is asking, and guys, we'll get to that because it is a superb question and something that I think we can really address very well using a combination of Nadex spreads along with the underlying. So we can set limit orders out though to lock in profit. So we could wait till expiration. In this case, if we buy at 75, the market kind of moves up and then moves over, it expires at 77. This is all based on the underlying market. This isn't something that Nadex controls. So this would be the crude contract, and what happens is how we expire our contracts. That's why they're derivatives. So it expires at a settlement of 77. We bought really at 25, made 175 on the 25 up. Or we can set limit orders out, or we can manually close out at any point up till expiration. Whether it be, if we're trading 10 contracts, we could take off 5, we could take off 7, we could let the others run. There's a lot of flexibility there. And so this is kind of the basic thing. And Anthony, right now, can't do, technically can't do an OCO on it, but what's going to be happening, an update is going to be basically a contingent orders. The OCO, basically, if one's canceling the other, you're basically talking about taking out a stop. But what we are going to have is, if you get filled on a limit, we're there in front of the screen. That's still something in development. Right now, it's currently all limit orders, but great question. So one of the things with spreads to keep in mind, there are a lot of different ranges each day. So there's not just one range published. There's going to be multiple time frames. So daily, and then there's 8-hour, and there's also intraday. With this, so there's typically going to be a floor or ceiling very close to where the underlying market's at. And so we're always going to try to use the floor or ceiling, at least in my opinion, as a way to manage our risk when we're getting in. And with these, they're short-term contracts, and we'll talk about how to swing, basically. That doesn't make any sense, because if the longest duration is a day, how the heck do we do that? We'll take a look at an example of that as well. So, oh yeah, one thing I do want to mention, as the market's moving throughout the day, so let's say this is a market. We've got the market right here. This is the Euro USD at 130. Market at 8 a.m., we've got all of these spreads, so various time frames. As the market moves, we continue to publish additional spreads on the market. So you'll typically always have a common floor and ceiling to trade from. So let's take a look at an example, and I think this is where we'll get, and we can kind of talk about, while there's not an OCO, or actually not a trailing stop necessarily on Nadex, how we can use them in conjunction with the underlying market. And this really goes to managing your risk. And if you look at any trade, whether you're a swing trader or whether you're a very short-term trader, all of the risk should really be in the first, 2, 3, 4, maybe 6 hours of the trade. And I say that because nobody's a swing trader, at least successfully, if they're allowing the market to run against them for 3 days or 4 days or 2 days, right? If it's a loser, if you're wrong, you want to get out of that trade. So with that in mind, thinking that all the risk is up front, which it is on any trade, or if we're managing a trade and we see that the market, we've got something coming up, we might want to manage it. What we're going to take a look at is kind of, some people call it hedging. I don't necessarily like that term. I grew up on a farm in a very small town, and I think of hedging as something totally different, not on a speculative front. So let's just say though we were looking to execute a trade. This is the Euro USD. Again, this could be any market. This could be the E-mini S&P, the Dow, the Nasdaq futures. It could be commodities. This is just, again, a typical trade setup. So let's say if we were looking to go long at 131.35. What's the next logical question? Okay, where do we put our stop? So we might look for, different levels of support or resistance. In this case, we had some down at 130.10. That would be a 125 pip stop on a standard contract, $1,250. To be honest, that would be a lot more than what I was ever willing when I was actively trading currencies to get in at 125 pip stop. But you know what? Some people will. This is just, I've moved it up. We could look to possibly get closer. Let's say we're headed up to a fundamental, maybe an FOMC or a Euro announcement. This is how the trade sets up. So how would we be looking to use these in conjunction? We've, again, got a spread ceiling. There's multiple ranges published every day, so there's typically a ceiling or a floor close to our position. Here we've got a spread ceiling of 131.50 and a floor of 129.00. So that's 250 pips in currencies. If you're looking at the E-mini S&P, we might have like a 40-point range. So let's just walk through this. What we're looking to do basically is take insurance. We're long the underlying market, which could run forever for us or against us. We've got our stop at 130.10 though, so if it does drop down, we get stopped out for the loss. So what we're going to talk about is, well, how can I still place this trade, actually have a stop loss farther back, but take on less overall risk? So let's take a look at how this might set up. So we've got the underlying market at 131.35, spread ceiling at 131.50. Yeah, before non-farm, Wayne, great point. A lot of people throw these on, particularly if they're managing. Maybe they've had a trade on for 2 or 3 days. Maybe they got in on Wednesday and they're heading into Friday, and they don't want to keep a stop. What I used to do is, before those fundamentals, if the trade was running in my favor, a lot of times I just pull it out, because why give away everything back to the market? So something like this might set up in front of non-farm or really any other fundamental, maybe GDP announcement. So what we've got now is we've got this spread, which is there in yellow, probably selling this at 131.25. We might have to pay a little bit more premium if it is in front of a fundamental announcement, because when you see any type of options, when you've got more volatility, there's typically higher premiums. For this example, though, we're going to say 131.25. So now we've got 25 points basically risk on this spread contract. So $25 per contract. If we were doing an equivalent, so a per point equivalent, we'd trade 10 spreads for the Euro USD, basically $10 per pip. So now what we have this 25 points. The worst the spread can do is the ceiling, but really we're already in long at 131.35. So these are just trading at a 1-to-1 up to 131.50. We've basically got 10 points here that we can lose on this spread. And yeah, actually, Sam, I'll touch on that there very soon here when we get towards the end here. I know a lot of people have been on, so I'm just going to do a couple of examples here, and hopefully if I don't screw it up too bad, Morgan will have me on at some point in the future where we can get a little bit more into the advanced strategies. But if you haven't seen these before, what I'd like to do, and I'll show you how you can get a demo, go in and trade it first. Oh, Morgan already said yes, so I basically got technically 21 minutes to really screw it up so he doesn't retract that offer, but hopefully I don't do that. So basically what we have now is we've bought insurance from 131.25 down to 129.00. So remember where we had our stop loss at 131.10? Now we can move our stop down to 129.00 or somewhere in that area, because that's where our protection is. So before, when we were trading just basically a straight FX position, we had $1,250 risk down to our stop. If we got stopped out, we lost $1,250. Now we've moved our stop all the way down to 129.00. So now we've got basically 235 points, or 235 pips protection. And Arthur, great question on that. And as far as the stop, BH, your stop is still in the underlying market, on the underlying position. And I'm going to show you a couple different outcomes. So basically, what we're doing is we're looking at a trade where we have unlimited upside because we're trading the underlying, which can run forever in our favor. We're using a short-term contract, though, to manage that risk. So let's walk through this scenario. Now the stop in the underlying is at 12900. So let's say an announcement comes out. Okay, bam. The market just fell down. That, if you can't see the chart, it's a little bit small, but it fell down to about 120, 129.80 or so, then bounced back up to 129.30. So in this case, let's say it's right at 120, 129 or 130 right now. So in the underlying position, one, we would have been stopped out if we would have just traded that. But because we had this insurance, we were able to set our stop at 12900. Right now, the market's at 130. Effectively, we've lost 10 pips because we bought this insurance. So on a one-for-one basis, this market drop here, everything below that red area was covered by the spread. At this point, we can say, okay, we were wrong. Let's just get out of the underlying and close out the spread. We lost 10 pips. Pivot points are great to use on these as well if you're doing technicals, particularly if you're looking. Now, there was a question on the max profit. So on the max profit on this particular trade, because again, we're using them in conjunction. So now basically though, if it did drop, I can decide what to do. But instead of losing that 1250, I lost $100. I limited my losses. I actually took on more risk in the underlying, was able to comfortably move my stop away, but I actually took on less overall risk. Now if I wanted to do this, okay, I could even just say close my spread for 125 pip profit, move my stop back up underneath this, and then see what the market does. Basically, I'm getting in at a lower point. Or, and here's where the max profit, who knows what the max profit is? Basically, if this scenario happens, instead of dropping, the market shoots up like this, we're hedged to 131.50. So we had this. So basically, we're making 10 points here. We're doing a one-for-one on the underlying market of the spread. So anything over 131.50, so let's say it moves to 133.00, we basically made 100 on the underlying market. We'll do the math here. We made from 131.35 up to 133.00, so 165 pips. Now we had the spread of 25, so once the spread hit 131.50, that's where the hedge was rolled off. So, or we stopped losing any money on the spread. So we basically, out of a 165 pip move, gave up 25 pips. So we made 140 pips. If it runs up to 140, it can continue to go from here. Now what we can do though is manage our stop through profit, or we can continue putting on spreads depending on how we're managing it. So we basically bought cheap insurance. We got in, we were able to basically get in at much lower risk if it went against us. We gave up a slight bit of profit if it went in our favor. But for me, if you look at being 50-50 and you go, well, I lost 1250 on one, but I had to give up 25 pips on the other, it kind of balances out. So I ran through this kind of quick. I know people have been on here quite a while. One of the initial questions is, what does it cost? James, the components of the spread trade. So basically on this one that I just covered, you have an underlying market. So long or short, you've got your initial trade. What you're looking to do is, if you're long the underlying, you're looking to sell a spread close to the ceiling, because you're looking at risk against your underlying position. You're looking to basically buy insurance to a certain level. If you're short the underlying, you'd be looking to buy the spread near the floor. BH, in this case, the stop was in the underlying market, but the stop moved all the way down to 12900, so you still had that protection. So without having that stop on the market, you actually moved your stop, or we would have been able to move our stop 135 pips away. An equivalent in like stock index futures might be, we could have a 20-point stop on the E-mini S&P versus a 3, but actually take on less position risk. So in this case, because we're using that spread, we don't want to stop on that. We want to be protected on the spread, because that's what's protecting our underlying position. It's the insurance on our underlying position. Now, if it made a big move down to 12800, I want to basically get out then at the floor of that. When my insurance runs out, I want to get out of that trade. So to become a member of Nadex, there's no membership fee, an initial deposit of only $100, because you can trade these contracts literally for 5, 10, 15 bucks. Pretty small exchange fees, 90 cents per side, in out. If it goes to expiration, it's 90 cents if you made money. If you didn't, it didn't make. The fees are capped at $9 per order though. So if you're looking at trading 50 or 100, like for instance, there are guys that are trading 5 contracts of oil, will trade 50 contracts on Nadex to offset that. So basically that would still be $9 because they're capped at that level. For anybody on that's not in the US, very soon, we actually are working with a few brokerage firms that we're getting connected into Nadex. So while Nadex rules, the way we're structured only allows us to take US residents, US entities, very soon you'll be able to offer these contracts, and we'll let everybody know. If anybody wants to shoot me an email, if you're international, well, actually, if anybody wants to shoot me an email with questions after this, shoot me an email. Actually, let me throw it up right here. I'm gonna set up 2. Chip Frame, who's on here, is my counterpart here, and actually he should be doing this because he knows probably 72 times more about the market than I do. The only thing I have against Chip is that he has this cat calendar hanging in the office. I guess he likes kittens. Actually, that's an inside joke. That was one that that Morgan sent to him one day as we were talking. As far as London, yeah, when we get when the brokerage firms come on, I would expect mid-September. Let's see, typing out Chip's email here, chip@nadex.com. So there are 2 email addresses. Those go directly to us. Wherever the brokerage firms can offer these, that's outside the U.S. that sends me an email that's interested in this. When we get into you know, the brokerage firms, them connected, like I say, probably mid-September, then it'll be open basically anywhere that they can offer the contracts, which is pretty much globally. Chandra, actually, Nadex is not only for day traders. And the reason I say that is actually whenever you're starting a position, so these are short-term contracts, but if you're looking at starting out a trade, and actually I'll just run through an example real quick. A lot of times, here were some other ones if we had more time, but if you're looking at a contract, and actually, unfortunately, currently there's no IRA accounts. It's kind of unique in that we are an exchange and how we're structured, that we still take the direct member. Through brokerage firms, though, you'll have a lot more flexibility in the types of accounts. Where more trade, you know, LWS, the question is where more trades are successful with Nadex, index trades or crude or currencies. Here's the thing, guys, we're an exchange. We don't make pricing. That's up to market makers and members. All we're here, our entire service basically, is to match buyers and sellers. So we don't, for us, it's a zero-sum game. If somebody's buying, somebody else is selling. So it's completely zero-sum. So trades are successful depending on the side, I guess, that you're on. Elena, yes, crude is $1 per tick. So at per cent, basically. Per 1 cent move, it's $1. In the underlying market, if you're trading crude, it'd be $10. So if you're looking to do a hedge, you could you know, do 10 contracts on Nadex. Oh yeah, LWS. Yeah, we keep all the stats on trades. We have to file those with the regulators. But basically, my point is, for us, there's 2 sides to every trade, and it's a zero sum. So somebody's going to win, somebody's going to lose, is basically how it is. So it's always 50-50. There's not one that's better than the other because every single trade, there's always 2 sides in our view. So somebody's always going to make money, somebody's always going to lose money. It's just how it is. And that's basically how all markets, with exception to equities, if you're trading futures or Forex, it's always a zero-sum game. With stocks, outright stocks, it's a little bit different because there you're actually buying a piece of the company. If you're buying it and the company value goes up, that's great. Everybody's happy. The people that work for the company, the people that own the company, and the people that invested in the company. When it goes down, yeah, people are more, you know, a little sadder. On futures and Forex, long and short doesn't matter. Always a zero-sum game. Metals, I'll run through the metals real quick. We've got copper, gold, and silver. And actually, let me just run through them. For the equity index futures, it's contracts based on the E-mini S&P, the Dow Mini, the NASDAQ Mini, the Russell 2000, as well as FTSE DAX and Nikkei. Commodities, we've got the eggs, corn, and soy, as well as the metals I just said. crude oil and natty gas. And Elena, I'd have to look up, we publish every day if you go to nadex.com, and I want to mention that real quick. Oh, thanks, Chip. If you go to nadex.com, we have a daily bulletin which tells what the volume for that day is. One thing I'll mention on the point of liquidity is there are market makers who take care of these. So you'll always see what's published. This is a market, so you can see what basically is up in the market. So what I'd recommend is you go into the demo, which if you go to nadex.com, go into trading, hit a demo account. It takes about 30 seconds to register. You can get the demo. Don't take what I say, and just trust it. I know my wife certainly doesn't, and she knows me as well as anybody else. Trade, and I'm a firm believer in this, because markets don't care. They will take money just as much as they give it. It's a great thing about the markets because they don't care if if you've got PhD and 17 other letters behind your name, or if you barely passed 5th grade. I fall towards the latter there. They don't care. They're unbiased. Get into a demo account first. Don't just hop into a live. Try it out. We offer a 2-week. Demo. What we do though, and actually as part of Trading Pub, and there's a lot of great information on Trading Pub which goes a lot more into this. If you email Chip or myself, if you've got a live funded account, even if you're not trading your funded account, if you've got a live funded account, we'll extend your demo out as long as you need it. So basically, what we want everybody to do, it doesn't do anybody any good if somebody comes in, puts $5,000 in an account, places one trade, and just blows up. That's not good for anybody. It's not good for the trader. I guess it might be good for whoever's on the other side of the trade. We don't know who that is. That's one advantage of Nadex versus somebody that might be actually a firm that is just taking the other side. Nadex never takes the other side of your trade. We're just there to facilitate. Yes, Jay, that's a great question. Yeah, I can't say exactly who they are because we're under a non-disclosure with all of them, but we will be making big announcements. But yeah, trades like firms like that will be ones that will be offering these contracts, and so that's what we're working on right now. And yes, Martha, like binary options, there's a lot of what I'll call firms that are they're the house. One thing that's different about that versus an exchange is with an exchange you get transparency. So if you want to see the how the underlying market settled, through Nadex, you can get the time and sales, and you can see if you're trading oil, where oil settled based on the underlying market. As well as, so in addition to the transparency, when you're trading, the other person you're matching against. So if you're buying and whoever's selling it to you, whether it be a market maker, a designated market maker, or another member, they don't know whether you're opening the trade or closing the trade. So you have anonymity. So they wouldn't know how to trade against you. They're just looking to get their fill, you're looking to get yours. Yeah, Sam, you know what? Even if you're not in the U.S., you can get a demo account. So you can, come in, try it out. Like I say, in a couple months, it'll be available for non-U.S. through some different firms. And let's see. Looks like Chip. New platforms when brokerages come on. Yes, actually, we are working with some additional platform providers as well. What I'd love to see is these listed on several different platforms, because I think it's a lot more convenient when you have a platform when you can trade futures, forex, maybe stocks, maybe options, and Nadex all on one. Yes, Susan, are there slower explanations on your site? There are a ton of videos, as well as if you go to our YouTube channel. If you go into YouTube and type in Nadex, you'll find our YouTube channel, as well on Trading Pub right here. And one of the reasons I love working with Morgan, not just because he's a great guy and he loves, and we love working with him, but he has a lot of great information on the website. We've done a lot of these videos. A lot of you have heard Daryl Martin from Apex on here talking about these. There are a lot more that go great into much deeper content than this in a slower manner. This is really to give a much higher level overview and just a few examples. And with that, I think Chips has taken quite a few of the questions, but we've got a few more minutes here. Yeah, good. Morgan put up Morgan put up the link to their place. Go to their lander pages, and TD bonds. Right now, we don't have any plans on the bonds. Actually, I'll answer two questions. One on the bonds. We have been. It's something we've looked at. We've also been asked a lot about equity index futures. So if we did bonds, it would have to be the bond futures because of regulation. We're not registered with the SEC. Something we'd be looking at, one of the things that we have to make sure of before we list anything, first of all, we have to file with our regulator in how it's structured, as well as the traditional contracts may be. We have to make sure that somebody's there to provide the liquidity. And they have to be able to provide pretty deep liquidity in order to satisfy their agreement with the exchange. It doesn't do us any good to list it if nobody's trading it. So, you know, that is something that we've looked at, and you know, if you go to Nadex and get a demo, we'll put you on the mailing list. So as we bring on new contracts, new products, you'll be updated. Awesome. Well, looks like some of the questions are answered. Again, if you think about a question later, get into the demo, shoot Chip and I an email, or you can email. And so if you're in the demo and you have questions, you know, talk to them, and you know, a lot of them have a great deal of trading experience. So you know, like Chip just said, questions, not Brent crude in this case, but let's see, long-term, longest term options is a week on the binary options. These are daily, and oh, thank you, Adam. That's awesome. I really appreciate that, and glad to hear that. You know, I before I was ever with Nadex, I saw what was happening. I'd spent a lot of time in the space working with retail, with, you know, the active individual traders, sometimes referred to as retail. And when I saw the contracts and how they set up and how they could be used in conjunction, it really kind of blew me away. I'm obviously biased now, but let's see, can you do this with an IRA account? Not currently, but when we do have the brokerage firms on, they'll probably have a lot more flexibility in the types of accounts that they offer. What are the hours for the next one? The exchange is open from Sunday afternoon, 6 p.m. Eastern, to Friday, 4 p.m. Eastern. Closes 1 hour each day to reset contracts. Depending on the market you're trading, it may have different hours. For example, the ags are a little bit shorter because they go by actual floor hours. But a lot of them, like currencies, are available basically 23 hours a day, Sunday evening through to through the thing. So if you go to our website, you can find all of the contract specifications. Let's see, what happens if I put in my personal details and click on apply for demo? But you should be able to check if you may have not used enough characters. If you click when you put in the username, it'll be demo dash. I think it has to be 6 or 8. But if you click on check that, it should tell you. Is there a limit in the amount of funding? No, there's as far as I know, there's no limit. I mean, you can put in $100. There's a down limit. In order to become a member, you have to fund with a minimum of 100. But you know, George, if you've got 10 million that's just sitting around and are looking for something to do with it, well, actually, if you do, let's say, you know, give me a shout. We'll talk separately. But yeah, I mean, 10 million, 100 million. The thing is, I mean, obviously, if you're trading 100 million, these are contracts based on, you know, for the individual trader. So if somebody has 100 million, like a hedge fund, this is a point I want to make. Hedge funds, there's probably not a deep enough book right now for them to do it. This is an exchange designed for the active individual. With that, I want to say one thing also. We don't allow high-frequency trading to take place. A lot of you are familiar with this term. We've heard of that over the years. There was just a big firm here in Chicago fined millions of dollars for, you know, basically illegal market practices. Nadex, we want to keep it a fair playing field. So we don't allow anybody to buy speed into the exchange. Everybody has to come in. It doesn't matter if you've got 10 million or $100. You all come in through the internet. So it keeps the playing field fair. The only exception to somebody that can actually cross-connect with our servers, if you don't know what that means, don't worry about it. It's basically a fast connection, is somebody who's an obligated market maker who has to make double-sided liquidity, provide a service of depth to the market, as well as be in the market at all times, and do it within a certain bid-offer spread. And with that, wow, you know, Morgan, I lied to you. I thought I'd have this wrapped up, but a lot of great questions. This has been an awesome group. Can't wait to do this again. Again, I know Morgan's put up the link a couple times, and it's been a great group. And with that, oh, it just beeped me out. Anthony, no, 5 minute, 15 minute, 30 minute. I mean, you can trade 5 minutes, 15, and 30 minutes up to the expiration. So you can effectively do that if you want to. But no, all the contracts, the shortest duration is 2 hours. And awesome. With that, I will turn it back over because I'm sure Tom is ready to go. Thank you all.
Great. Thank you, Dan. We greatly appreciate you and Chip taking time out of your Saturday to be here, and all of you guys in the room as well. I'll type in this link again if you enjoyed that, if you think that might be something you'd want to use for your trading. And I'll tell you one more thing. We did this last month. We did a Nadex trading contest where we gave away $5,000 worth of prizes. We gave away, I think, $2,500 to the first place trader, and then about $2,500 to places second through 10th place as well. And we're going to probably be doing another one in October, I believe, either September or October. And so anybody, what we do is we typically limit the number, you know, to 200 traders for those. That's what we did with the last one. But anybody that is on our form that has asked for more information on Nadex are definitely the first people that we let know about it. So if you might be interested in a future trading contest that we hold with Nadex, if you want more videos about Nadex, if you want the link with the demo, we automatically email all that to you when you put your information in on that form, so you can just click on that and get more information on the strategies. But it's a great market. I personally trade it, and we've been working with Dan and Chip now for over a year trying to spread the news about Nadex, which is really cool because it offers active individual traders like ourselves a place to trade without all the high frequency traders that are jumping in and jumping out in milliseconds. So again, it's very cool, and yeah, and Dan definitely are. So you guys check it out, check out the library. It's all free, and then you can continue to learn more. I hope that you guys are enjoying today's presentation so far. We've got one more speaker lined up, and so I'm going to get his slides loaded. But real quick, you guys enjoying this so far? I want to make sure you're still with me. Everybody's still awake? Good deal, good deal. We appreciate you guys being here. Yeah, Susan, your head wants to explode. We're recording all these sessions. We'll get all of them published for you. So no worries on that front at all. All right. Okay, and same drill as last time, guys, with this slide. If for some reason, you know, we just reloaded the slides, there's a lot of people here in the room. If for some reason you cannot see the slides, hit the blue, there's a blue X in the top right of the screen. If you hit that blue X, it'll give you the opportunity to reload, and you can reload the slides, or you can come out and come back in. But again, click on that blue X, and that will give you the opportunity. If for some reason, if your screen's showing an error that says like no slideshow detected, you should see a blue slide that says DTI. And John will get the recordings emailed to you by Monday afternoon. So Monday afternoon Eastern Time, US time. All right, well, at this time I will turn things over to Tom Busby. Tom's going to cover a couple of things he's been looking at the markets recently, as well as the irrational exuberance trade, which is a trade that he takes each morning from about 8:30 to 10 o'clock Central Time. So Tom, at this time I will turn it over to you, and you can take it away. And just one last quick reminder, if you can't see the slides, all you have to do